Hey, my friend, it's Mark Yegge here. I'm just doing something that's a little random today. And I thought maybe we could just have a little conversation, right? Of course, it's a video and I know what that means. But in other words, I'm going to treat this like you're there and we're having a conversation about covered calls. And I'm not going to go through a bunch of technical jargon. In fact, what I'm going to do is over here, I'm going to put a little fire, right? I'm going to see if I can do this over here above my shoulder. I'm going to put a little fire so that we can kind of sit by the fire, maybe grab a drink or a cup of coffee or tea, and just kind of have a fireside chat. Now, I want to talk to you about, this is my favorite strategy, and I've been investing for more than 40 years, right? Probably like 45, let's say. And I've traded billions of dollars, over $14 billion of securities. I've seen everything that you can possibly see, I think, in the markets. I've seen bull markets, bear markets, stupid markets, smart markets, markets induced by the Fed, markets not induced by the Fed, markets hysteria, any kind of market you've seen. I've probably been there and made money in it and lost money in it. So I know where the bodies are buried, so to speak. So I just want to have a chat today about covered calls because there's a lot of people out there putting out videos on covered calls. And hey, it's a good way of trading. So it's no surprise that people are putting videos out. But I want you to be careful about what you're watching, because generally when you get something for free, and I know these videos are free for sure. And you also know that I'm selling something too at the end of this, but that's part of it. But the main part of it is I'm like at the age now where I want to help people. And this is my way of doing it. Like, I think that's why I was put here. And so I've come up with this really cool strategy called the cash flow machine, which if you watch any other of my videos, you know kind of what we do. And it's basically a modified covered call strategy that I've created from my mentors, distant mentors, right? People like William O'Neill, who is the guy that created Investors Business Daily, the Can Slim method, which you may have heard of. It's a breakout trading method, which I use. And Edward Thorpe, who to me is one of the geniuses in trading, although he's been out of trading for so long, but he created this system that we use on covered calls before there were even calls, right? It was only with warrants that he created this way back when. So he wrote the first definitive book really on the market, and it was called Beat the Market. And this guy ran a hedge fund. It was one of the most successful hedge fund managers, and he retired way, way, way before he should have retired. But maybe he's figured it out all out and he's got a better life now. I get it because I run a couple of hedge funds. Anyway, a lot of people put out free videos. And so they put out free videos and they're simple. Hey, go out and buy a cheap stock and then sell calls against it. Well, I've done that. Okay. Seems like a good idea. I don't have that much money, Mark. I can't put a lot of money in the market. So I'll buy this crappy stock and I'll sell calls against it. And maybe for a short period of time, you're going to make a little bit of extra money. And then after a while, I've seen what happens to crappy stocks is that they're not held up anymore. And so they crash. And now you've been making 4% a week on a crappy stock when you could have been making 2% a week on a solid stock, but now the stock goes down 20%. And now you're stuck because you watch somebody's free video that basically told you, because you don't have a big account and they were trying to be nice to you, go out, buy a cheapo stock and sell calls against it out of the money. Okay, cool. That's one way of doing it. You know, they're called options, so you have lots of options, right? Lots of choices. But to me, that's not always the right way to do it. We have a system in the cash flow machine that uses 4 cornerstones. And I'm kind of just going to talk to you about them just for a minute, just so you can kind of get an idea of why it's so important. But it's the right stock in the right market at the right spot on the chart, and then you squeeze the juice. You collect the time premium. You get the rent from the stock. So we start with the stock. So let's say that you've worked all your life and you're 55 years old and you're thinking about retirement. Your kids just went to college or whatever. And now you're like, oh man, I got to retire in 10 years or 5 years or whatever my goal is. What am I going to do? I haven't really done that great a job. My broker's only made me 3% over the last 20 years. I haven't really gotten ahead. And the kids have spent all my money because I've been putting them through school, or they've been, it costs money to raise kids. And you just haven't put enough money away. And now you're looking forward going, wow, where am I going to get all the rest of this money? And it is going to be expensive. And here's the kicker is that when you retire, you don't know how long you're going to live. So You don't want to run out of money before you run out of life. So that's the conundrum. It's like you're in the situation where maybe you don't have enough money. Well, I can tell you, if you go to some of these free videos on YouTube, and look, I believe in education and I believe in YouTube, because believe me, when I need to change out a light bulb, I might go watch a video on YouTube, or when I change something more specifically on my car or something, I watch a video on YouTube. YouTube's got some great stuff. It's also got some pretty crappy stuff, if you know what I mean, right? It's not all really good, highly educated stuff. Although there's some great things, you're going to have to sift through some of the junk. Now, I want you, when you're thinking about covered calls, and it's, believe me, to me, it's like the best strategy. So even if you just watch somebody else's free video and do covered calls, you're probably going to be a little bit better off than somebody that doesn't. So believe me, I love the strategy. Now, anything worth doing is worth doing right? So I think you should have some kind of system around your strategy, right? What most people do is they kind of wing things in their life, right? They're like, oh, hey, somebody just told me how to do this covered call, or I saw this video where the guy's making 10 grand a month. It looks so easy. And let me click this mouse and spend 100,000 or 50,000 or $150,000. And you've got a covered call going. And maybe you make money the first time or two, right? It's like hitting the drive down the middle the first time you grab the golf club. It could be like the worst thing that ever happens to you, because then you're hooked on this game if you hit it down the middle, but then you haven't learned right. So you're going to go all over the place. That's what I do anyway. So anyway, you're going to, you're going to go out and learn this strategy, but you need to learn it the right way. You need to have a system. You need to not wing things in your life, right? If you wing your relationships, if you wing your career, if you wing your health, if you're wing, pretty soon you're not going to be doing that well, right? Things that are thought out, things that are planned, things that are methodical, you're probably going to do way better in those things than things that you wing in your life. Now, there's a place in life where creativity comes in, and winging it is great, but not in money, right? In money, you have to have a plan. And what I want you to do, what I hope you do, is I used to be a Wall Street guy, so I'm allowed to say this, right? And they hate me for it. But some of the crap that they spew on Wall Street is not good for you. It's good for them, but it's not good for you, right? How many of you heard that you should have a 60-40 portfolio of 60% stocks and 40% bonds? Okay. Now, the 40% bonds was making you about 1.5%, 2% a couple of years ago, right? And then the Fed raised interest rates. So what happened to those bonds? What happened to those safe investments that were supposed to hedge the volatility that you get on the stock portfolio? Well, the stock portfolio went down and bonds are supposed to go up, but bonds went down too. So you lost 30 for 40, 25, whatever the percentage is, depending on what fixed income instrument you were in. And it wasn't so damn safe, was it? And that's what Wall Street tells you. Don't worry, over time, it'll be fine. That way they can hold on to your money and make fees on it. I used to do that same thing. I'm not proud of it, but everybody has a right to make a living. But I think if you have a right to make a living, you should have a right to have a plan. And so you should have a plan. And so we do the 4 cornerstones: buy the right stock in the right market at the right spot on the chart, and then we collect the juice. So let me go through those real quick. We start with the right stock. And I just watched a video of somebody, really, really well followed guy on YouTube. I'm not going to say who it is, but I appreciated his content. The part I didn't appreciate was that he was catering to people that didn't have much money. And look, if you don't have much money, there's nothing wrong with that. But I'm not going to give you a strategy that's not right for you just because you don't have the right money, right? Figure out a way to get the right money so that you could do the right strategy. Let me not mash a strategy in because you don't have the money. So I was watching this guy and I'm like, wow, he's saying buy cheap stocks. Stocks that are junk is what he was basically saying. I don't know about you, but when you buy something that's crappy, you get what you pay for. And just because the stock is cheap does not mean it's good. And it doesn't also mean it's going to go up. In fact, when a stock is cheap, it probably doesn't have a lot of institutional buyers holding it up when things get tough. Now you're going to look at me and go, well, Mark, Netflix went down 80% in a couple of years, and Facebook went down. I know all that. And those are good quality stocks. And those are the kinds that you should be in, because in general, they do get held up. But, we had a bear market, so those things happen. I'm just saying, I play probabilities on everything I do. I'd much rather have a a good stock with a lot of high growth prospects that's doing well. Think of like an Apple or a Tesla or a Microsoft or even a PayPal or a Visa. Like these are companies that are going to be around. Then some IPO thing that just came out that's all exciting, they've never made money. Like you can tell the difference between the quality of the stock. So you might have to pay a little bit more for 100 shares of Microsoft than you do for, 100 shares of AMC, that's got movie theaters that are being supplanted by Netflix. But is it worth it? I mean, can you look at me and say, hey, in 5 years, AMC is going to be around, a very strong company, just like Apple will be? I don't think you can. I can't. I know Apple's going to be around. I'm pretty darn sure. Maybe they'd be acquired by somebody or whatever, but they're still going to be selling phones in 5 years. They're going to be selling subscriptions and all that. I'm not so sure about some of these cheap $16 stocks or $25 or $50 stocks. So you got to buy the right stock. And the right stock, if you think about it, the institutions move around billions of dollars, right? So if an institution is moving around billions of dollars, think about that. They've got to buy a lot more shares of a $20 stock than they can buy of a $200 stock, right? I mean, they have to buy 10 times as many shares of a $20 stock. So if you want to move $10 billion over the course of 6 months into a stock, you're going to make lots of waves when you go in. So you're going to pick more expensive stocks. You just are. That's what every mutual fund, every institution that I know of does. And that's why you see the big stocks like Google and Apple, the ones that are really well capitalized, they've got a lot of big money behind them because they're a little bit more expensive. Now, Google was $2,000 and change before it split. Tesla was, $1,200 before it split. So that's when all the big money went into it. So you want to have the right stock. And what's the right stock? Well, you got to have good growth. You have to have increasing sales. You've got to have good return on equity. And I talk about these things in my courses, but I want you to kind of have your eye out for what you really need to have. All right. So you've got a good quality stock held up by institutions. That's what you want. You want a lot of mutual funds and institutions that have a lot of trouble moving in and out of them. They're not going to day trade these companies. So they're a little more powerful. Then you've got in the right market. Now, you're going to listen to a Wall Street adage that says you can't time the market. And the reason they tell you this, and they give you all kinds of statistics, like if you're out of the market, you're going to miss the biggest days of recovery and all that kind of stuff. That's fine. And they're probably right. You can always find a statistic to back up almost anything that you want. But when you want the right market, you get like a little bit of a probability bonus, right? I always call the right market like a tailwind, right? If you're sailing, if you've got a bad market and you're sailing into it, 70% of a stock's performance comes from the performance of the market, right? It's a stock market, a market of stocks. So chances are 7 out of 10 of your stocks are going to move in the same direction of the market. If the market's on a trend down, why are you buying? Are you smarter than the trader with, $2 billion to spend today? Are you smarter than them with all the Bloomberg terminals and all the tools they have and all the quant people around them, PhDs and all that? I don't know. I don't think I'm smarter than them. In fact, I think they're probably smarter than me because if they're wrong, they can continuously pump money in until they're right. I can't do that. I run out of money pretty quickly. So you've got to have the right market. Now, who knows I don't know when the market's going to go up and markets go down. Like I say, it's a probability game. And so if I can get the probabilities in my favor, that's what I want to do. Now, I have some market timing systems. There are some market timing systems that you can get, and you can use like the MACD and some other things that are free on your trading software. You can, and you should if that's what makes you feel comfortable. And by and large, you can make any statistical thing, any past performance thing like a MACD or an RSI indicator or Wilder's RSI, and there's hundreds of indicators. I have a system that we call the Genius system, and it's right about 85% of the time. And that is a tailwind. All I'm trying to do is get from the 50% chance of being right up to a little bit higher, because when you first click the mouse, you've got a 50% chance of being right and a 50% chance of being wrong. And so does the other person on the other side. And chances are they're probably a little smarter than you. So you've got to get an edge. Okay, I'll get to the edge in a second. But what we're trying to do is get our probabilities going from 50 to 52 to 54. And if you get everything working right, you might get a 70% chance of being right. Might. you're still that 30% chance of being wrong. Okay. So then it comes down to risk management. All right. So we've talked about the right stock and we've talked about the right market. So when the market's moving up, you want to be in that market, participating in that market and selling the right calls, because that's another piece of the edge that I'll talk about in a second. And when the market's going against you, you want to be a little bit more conservative. You don't have to necessarily be in cash. You can be. The problem is, when do you get back in? Usually when you get back in and the market turns, there's all kinds of negative talk on the street about how the market's going to zero and this is the worst recession and blah, blah, blah. And so you never kind of get back in at the right time. You start chasing. So I'm generally, just because I've been in the market for so long, I'm generally always in. Doesn't mean I'm right. It just means that sometimes when I'm wrong, right, when the market's going down against me, I look back and go, I probably should have been in cash. But you know what? In my system, being in allows you to stay in and shore up your position. And that's what I do. All right. Right stock, right market. Two of the most important things to get probabilities on your side. And then every chart has a few spots on it where you get the highest probability of being right, right? So like a breakout has some momentum behind it. And then if you can catch that breakout as it's breaking out, or maybe just a little bit before, hard to do, then you can ride those breakouts. And a really good breakout will go 20, 25%. That's what most of them do. Some go up for a long time, but most go up 20 to 25% and people take their profits. So you can use a breakout strategy. You can use a break above the 50-day moving average strategy, a golden cross strategy, other moving average cross strategies, a MACD strategy. There's lots of different strategies that you can use to find that best spot on the chart. But that's going to get you a little bit more probability. That's not going to guarantee that you're right, because 40% of all breakouts fail, which means 60% of the time you can be right on that part of it. Well, that's kind of cool. But, there's little things like that to get the right spot on the chart working in your favor. So now you got three things that have all increased your probability. You got the right stock. That's a huge one, right? You want the right stock. And by the way, you want a stock that you feel comfortable in, that when, things hit the fan, you know what I'm talking about, you can still stay in that stock and go, you know what? They're not going out of business. This is a bunch of fear, right? I was in Tesla last year and the stock was just relentlessly getting sold off. Elon bought Twitter. Elon was selling shares. People were poo-pooing. They were piling on. They drive that stock down. And, it went down a lot more than it should have. And it went all the way down and then it rebounded by 80%, right? And if you didn't have the wherewithal to stay in it, and I know a lot of people that didn't, they all bailed at the bottom, okay? I was accumulating a little bit more and fortifying my position. Not going to get into exactly how we did that. That's all covered in our course, but that was part of my strategy. So while it was going down, it did not feel good, trust me. But I just knew that my position was right. Now, I would have been wrong if the stock went to zero or never recovered. Okay, yeah, I get it. But that's why I want to be in a really good, solid stock, right? So you got the right stock, the right market, the right spot on the chart. And then our biggest edge. What is our biggest edge? Well, I teach my students to try to get 2 to 4% a month, or 1 to 2% a week. Now, it doesn't sound like a lot, but let's think about that. If you could make 1% a week, and I'm not saying you make 1% every week, I'm saying over time, you should average 1 to 2% a week if you're doing the system right. And if you think about that, 1% a week is 50% a year. 2% a week is 100% a year, right? 50 weeks times 2%. That's a doubling every year. Again, I'm not saying you're going to do that. I'm just saying you should design your strategy, your trading plan around something like that so that you can do that when the stars align. I talk about my IRA a lot on this channel and, in my program a lot. And this is an IRA that I started in 2020 on April 30th, I think the day was. And I talk about this, so you could probably go find out. I got lots of screenshots on there about what I did, and the good and the bad, by the way. And it went from 111,000 in this IRA, only doing my cash flow machine strategy and only doing it starting out in Netflix, like 3.5 months of Netflix. And since then, it's only been Tesla, one stock. And in that IRA, it went from 111,000 and over 23 months, it hit $758,000. So we do a lot of things that's obviously a lot more than 1% a week. but we do some things in our cash flow machine that gets you a little bit more leverage. It's called synthetics, but that's a topic for a later discussion. But it is possible that when you have all the tailwinds, the stock was the right stock. I was in Tesla mostly, right? Pretty good stock, certainly tripled. So I'm pretty sure that was pretty good. All right, so we got Tesla. Then we got in the right market. So we had a bull market happen in 2020, starting in 2020. It ended kind of 2021, but it started in 2020, and that was behind us. And then at the right spot on the chart, we caught Tesla right when it was breaking out at the pre-split levels of 300, and it went up to like 900 or 1,000. And you go, yeah, Mark, you got lucky on a stock. Yeah, sure. Okay, I'll take that. But over time, what we do is we sell against it every week. And so now we have way more shares, and the stock is like half of what it was once it split. And I've got way more shares. So if the stock goes up, I'm going to make a lot more money than I would have made before. So you got the right stock in the right market at the right spot on the chart, and those all give you an edge, probability edge. But the fourth one is that we sell calls, right? And if you take away all the other probabilities and you just sell calls, you can pick up, let's call it 2 to 4% a month. That's 2%. That's 24 to 48% a year. I think you'd be happy with that. I'd be happy with that if over time that's all I got. That'd be fine, right? So if you're grooving on that, and now I want you to think about the next thing. And that's going back to, remember what I talked about, those free videos that you get when you watch YouTube, these other covered call gurus that tell you how to do it. Most of them are telling you to buy the stock and sell an out of the money call. Okay, cool. That is one way to do it. And I'm not saying they're wrong, because they're right. Selling a call is great. You limit the upside of what happens when you sell a call, but you do get to pick up that time premium every week. Now, I want you to think about this little shape that I have in front of you. It's a bell curve, right? You've seen a bell curve before. Let's see if I could do this right. Yeah, something like that. All right, this arm goes up. All right, so the bell curve, the top of the bell curve is what you're going to get your most time premium. It's right at the strike price, right at the money strike price. Okay, you're going to get your most amount of money. You're going to have a 50% chance of it going higher than that price and a 50% chance of it going lower than that price. The farther you go out, the less chance that you have of collecting that. So if you go to the one side, okay, if you go to I guess on the screen, this would look like to the right where the stock goes up, yeah, you'll make a little bit of gain when the stock goes up. But if the stock goes down, the only thing you have protecting your account is the amount of money that you collected from the time premium, from the gambler on the other side of your trade, because we sell options, we get that time premium. So that's sometimes good, but it ain't always good. Like if the market's in a downtrend, or if the market has a rough day, they make an announcement of something, and your shares go from 100 to 95, and you sold the 105 calls for $1, you're $4 under the money, right? You started at 100, you only got $1 for it, so you're in it at 99. But now the stock is at 95, you lost $4. Better than if you just bought the stock alone, for sure. Because if you just bought the stock alone at 100, you'd be down $5. Okay, so you saved $1. But if this is a kind of market, remember that market timing, that second point is really critical here. If that market is kind of wanting to go down, and again, we have a market timing system that kind of gives you the trend, and you're on the downside of that, you're on the other side of that bell curve, well, instead of selling the 105s for $1, maybe you sell the 95s for $6. You pick you pick up $1 in time premium, but you also get $5 worth of what's called in the money protection. Now, I'm not going to go into it on this one. We're just having a chat of what in the money protection is and all the theories. We teach that in our course, but you can see my other videos and how we talk about it. So if you want to poke around and watch some of the videos, you'll probably pick up a few of the concepts of how I do this. But in a down market, I want to have protection, don't I? I mean, don't you? Like, you don't want to lose your money and have to wait for it to come back up. So if you can avoid that in a down market, great. And so the idea is that in an up market, you want to be maximizing the amount of profit potential and juice that you can get from selling the covered calls. And in a down market, you want to be really conservative. You want to protect the account when the stock is going down. And we have techniques and strategies that we show you how to do that. Like the stock keeps going down, we make these trade adjustments because we don't want you to lose money. The first thing is Warren Buffett's first rule. You know what his first rule is? Don't lose money. You know what his second rule is? Don't forget rule number one. So losing money, if you can avoid it, is like the most critical thing. Then we worry about the profit that we're going to get, the 2 to 4% a month. So does that make sense? I hope I'm making a little bit of sense. I just wanted to have a chat with you about the strategies and what we do here. We buy the right stock in the right market. You getting us yet? Right stock, right market, at the right spot on the chart, and then we squeeze the juice. And when we do it all right, we still only have about a 70% chance of being right about making money. That's way better than 50%, which is what you normally have when you buy a stock, because you don't know if it's going up or down. I don't either. I have no freaking idea. And I've traded $14 billion worth of securities. And I've seen probably 1 million charts right now by now, right? And I still can't tell you if stock's going up or down. I can tell you what the probabilities are, though. I can kind of get that in my brain. And then the last part of this whole thing, and I alluded to it earlier, is to have a system, right? To have a plan. And whenever somebody asks me, one of our students, I always tell them as they're learning, going through our course, maybe I'll talk about the course in a second here, but as they're going through the course, I say, listen, you need to have a trading plan. What happens when the market goes up? What happens when the market goes down? What happens when the stock goes up? What happens when the stock goes down? What are you going to do? Because when you think about that in advance, you don't make as many emotional decisions, right? I always say when emotions go up, intelligence goes down and vice versa. So you might as well be intelligent. Figure out your trading plan. Don't make it too complicated when the market is closed. That way you're not emotional. And you can create this beautiful little trading plan so you can follow it and not make emotional decisions. Because I don't know about you, I can tell you when I make decisions, some of my worst ones are when I'm emotional. So I don't want you to do that too. So in the course, by the way, we teach you a system, a strategy for creating that plan, because that's a really important thing. And you know what it all boils down to, everybody? It boils down to mindset. And I think 90% of this, you can watch all the free videos you want, including the free ones on my channel, right? I'm not going to pick anybody, make fun of anybody, unless I make fun of myself. But at the end of the day, it comes down to what's up here. Mindset. 90% of the game is mindset. If you have the right mindset, you're going to make money doing this, right? If you pick the right stock, you got a good probability of making this work because you get that edge from selling the call. If you pick the right stock in the right market and you sell the call, you're going to get a bigger edge. If you could find the right spot on the chart where it's always a tailwind behind you, right? Where the stock keeps going up. We want it to go up. We want it to go higher than our strike every week because that's the maximum amount of money that we can make every week. Then this system works. And I get a kick out of these people that get in my program and they ask me a question. They're like, okay, Mark, what do I do? My stock went down $1.50 this week. What should I do? Should I go to cash? Should I sell my call? And it's a simple answer for me because I'm just like, what's your trading plan say? Right? My job is not to create and tell you what to do. My job is to be your teacher, your mentor. My job is to be like, you show up the first day on the job and you're a carpenter, okay? My job is to show you how to be a carpenter, but give you all the tools that you have in the toolbox so that when you're on your own, you can pick out the tool that you want to use on the job. Some days the job needs a screwdriver. Some days the job needs a file. Some days it needs, a saw. What tools are you going to use? I can't be there to tell you what tools to use, right? It's a different strategy when the market's going up. It's a different strategy when you got $2, $3, $4 million in the market than it is when you got 50,000 in the market. I can't design that strategy for you. You have to do it. And it has to be from up here because you're the one that has to execute the strategies. Make sense? So I know I've been talking a lot, right? And I appreciate if you're still watching, thank you. So listen, let's start with the usual, right? If you're watching this on YouTube or Rumble or wherever you're watching it, please like the video if you like this. Hit the subscribe button if you haven't already subscribed. And that way and also hit the notification bell. And that way you're always in the know whenever I come out with a new video. Like day before yesterday, I just came out with a video on 1 week covered call on Netflix. If you don't take advantage of that, in the next 48 hours, and I'm not saying you should or shouldn't, I'm just saying you at least have the option to look at the information, then you're just using it as information, learning from it, rather than maybe a potential thing that you could, look into. If you want to find out more information about what we do here, I'd love to see you down the road. We have all kinds of stuff. I've got a book called The Cash Flow Machine, which you could start with. We have a free download called Regular Paychecks, how to get regular paychecks out of the market. Because really that's how I created this, is I wanted a way to not just for myself, but to help other people take regular paychecks out of the market, right? Every month. So maybe making 10 or 15 or $20,000 is the number for you. And this is a great strategy to do that. So we have a free ebook that you can download by going to our website. If you want to take one of our courses, we've got courses from, the very beginning all the way to very advanced courses. But if you really want to learn something right, no matter what it is, you should immerse yourself in it. Like if you wanted to become a good golfer, you wouldn't just go read a book by Phil Mickelson or whatever, right? That wouldn't make you a good golfer. Plenty of information out there. And I'm an information guy, so I got plenty of information out there. And you can certainly take my course and you'll probably do great if you apply it. The issue is it's hard to keep that momentum going, right? If you had a group that every Thursday and Tuesday went out and ran 3 miles, you would kind of run 3 miles twice a week more readily than somebody like me who's not a member of that group. Not that I want to run that much, don't like running, but I'm not going to be accountable to anybody. So if you want to learn anything right, you got to immerse yourself in it. We have a program called the Cash Flow Machine Mastermind Mentorship. It's a big old name, but it describes what we do, right? It takes our Cash Flow Machine courses. It teaches you the courses with quizzes. And unfortunately, you got to look at me a lot, but I go through a bunch of stuff with quizzes and tests, and I make sure that you get it. I help you with your first trade. And then we're in a mastermind group together. So you're in with me where I'm mentoring you in the beginning and maybe, forever. I'm still helping a lot of people several years in. And then we have a community of people around it that are all going through what you either are going through or just went through, right? They just went through it. So they know a lot of the secrets that they're learning and they can help you. And then on Fridays at 2:00 Eastern time, we jump on a call. Why do we do it on Fridays? Well, that's when options expire, Friday at 4:00. So we like to get on at 2:00, figure out what we're all doing. Why are you selling this one? Why are you rolling? Are you selling in the money? You're selling at the money, you're going out of the money, whatever. And we talk about our strategies and we all learn from each other. Okay. And we all participate and it's a lot of fun too. It's like a family. We get together every Friday. Yeah, it's a lot pricier to do that, right? I've got to pay teams of people and, we've got infrastructure built up around it. And I usually teach a little something. And, this is a business after all. But once you learn this program, once you learn this system, you've got it for the rest of your life. So it's not a cost of tuition. It's an investment of tuition. It's like, I went to college and I spent a bunch of money. And if I had to do it over again, I probably wouldn't have. Because I don't think I got much value from the lessons and the tuition that I paid for in college, but I certainly did get value in college. Maybe it was outside the classroom, but it was certainly something to go through. This is a fraction of what college costs, right? It's a fraction of the cost of tuition. It's a fraction of the time, but it's a piece of knowledge that teaches you how to make money. I went to business school. They never taught me how to make money. Isn't that funny? Like, how stupid is that? I went to school to learn how to make money. And the one thing they didn't teach me was how to make money. They taught me business law, statistics, economics, history, language, algebra, and calculus, and other stupid junk that I never use. I don't know the last time you did a derivative, but it's been a long time for me, like 40 years or 35 anyway. But I learned all that stuff and I didn't learn one class on how to make money. Not one, not even my finance class. Here in my program, at a fraction of the cost, we teach you how to make money and we give you a peer group to do it and a mentor to help you do it as well. So, all right, you've gotten my basic philosophy. If you're interested in doing that, I'll put a link down below. And so that'll be the place where you can go and you can maybe watch some more master classes on the philosophy behind this, or you can, you could see my IRA that I just alluded to, or you could just see some of the videos that we talk about. And you can kind of get comfortable with the philosophy of actually having a real system around a covered call strategy system. So listen, thanks for being here. Thanks for enjoying this fire with me. I appreciate your sticking out this long, and I'll see you on the next video. Take care.